In the fast-paced world of finance, options trading offers a really interesting way for investors to make money from market ups and downs. One strategy that stands out, especially when the market is jumpy, is called the guts strategy. Seasoned traders, those who've been doing this for a while, often use this strategy because it gives them a neutral outlook. This means they can potentially profit whether the market goes up or down. Now, the gut strategy isn't for the faint-hearted. It gets its name because it needs a bit of bravery. You'll need a stomach for risk and a good understanding of how options trading works. But if you get it right, the gut strategy can bring in significant rewards. This makes it a tempting choice for those who want to handle uncertainty and make the most of market swings. This video dives into the guts options strategy, giving you a complete guide to how it works, its benefits, and its potential downsides. We'll use NVIDIA, a big name in tech known for its stock volatility, as a real-world example. Whether you're a seasoned trader or just starting with options, this video aims to give you the knowledge you need to understand and maybe even use the gut strategy yourself. Remember, knowledge is power, especially in the ever-changing world of finance. Market volatility, which basically means rapid and big price swings, can be both good and bad for investors. Some investors avoid volatility, but others see it as a chance to boost their returns. This is where a neutral outlook comes in. In options trading, a neutral outlook doesn't mean thinking the market will stay still. It means aiming to profit from how much the price moves, regardless of whether it goes up or down. Basically, a neutral outlook lets traders benefit from both bullish upward and bearish downward market trends. This is especially important in volatile markets, where it's hard to know for sure which way prices will go. Instead of guessing if a stock will rise or fall, traders with a neutral outlook focus on profiting from the volatility itself. The gut strategy, with its special structure, is perfect for this. It's a useful tool for navigating uncertain markets. By understanding and using a neutral outlook, investors can potentially reduce risks linked to guessing the market direction and position themselves to profit from market fluctuations. As we'll see, the gut strategy provides a structured way to do this and potentially profit from volatility. The guts options strategy, as the name suggests, requires a bit of guts. It involves buying two things at the same time, a deep-in-the-money call option and a deep-in-the-money put option. Both of these are on the same asset and have the same expiry date. Let's break this down. A call option gives the holder the right, but not the obligation, to buy the underlying asset at a set price on or before a specific date. On the other hand, a put option gives the holder the right, but not the obligation, to sell the underlying asset at the strike price, on or before the expiration date. An option is considered deep in the money when the strike price is much lower than the current market price for call options or much higher for put options. This means the option has intrinsic value, making it pricier to buy, but also more sensitive to price changes in the underlying asset. By buying both deep-in-the-money call and put options, investors are essentially betting on a big price move in the underlying asset without trying to guess the direction. If the price goes up sharply, the call option gains value, making up for any potential losses on the put option. Conversely, if the price drops sharply, the put option gains value, making up for any losses on the call option. The key to success with the gut strategy lies in choosing the right strike prices and timing your entry and exit points. We'll explore these aspects in more detail in the following sections, using NVIDIA as a real-world example to show how the strategy works in practice. To show you how the guts options strategy works, let's look at NVIDIA, a leading tech company known for its high-performance graphics processing units, or GPUs, used in gaming data centers and artificial intelligence. NVIDIA's stock, NVDA, is known for its volatility, especially around earnings announcements and product launches, making it suitable for the guts strategy. Let's say NVIDIA's stock is currently trading at $400 per share. An investor decides to use the gut strategy, expecting a significant price move in either direction. They choose deep, in-the-money options that expire in 1 month. Buy deep ITM call option. The investor buys a call option with a strike price of $350, much lower than the current market price. Buy deep ITM put option. At the same time, the investor buys a put option with a strike price of $450, much higher than the current market price. The premiums for these deep, in-the-money options will be quite high because of their intrinsic value. However, this also means they are very sensitive to price movements in NVIDIA's stock. If the stock price moves significantly up or down, the investor will gain from the corresponding option, potentially covering the cost of both premiums and generating a profit. Entering a guts trade requires a systematic approach to maximize potential profits and manage risks effectively. Here's a step-by-step guide to entering a guts trade using NVIDIA as an example. Market analysis and outlook. Start by doing thorough research on NVIDIA, including its financial performance, industry trends, and upcoming events that could affect its stock price. Determine if the market conditions suggest a potential for significant price swings, which is crucial for the gut strategy to work well. Strike price selection. Choose deep-in-the-money strike prices for both the call and put options. How deep in the money you go will depend on your risk tolerance and the anticipated price movement. Deeper in-the-money options are more expensive but offer a higher chance of profit if the price moves significantly. Option premium evaluation. Assess the premiums for the selected options. The premiums represent the cost of entering the trade. Consider your investment capital and ensure the premiums are within your risk management limits. Simultaneous order placement. Place simultaneous orders to buy both the deep in-the-money call and put options. This ensures you're entering the trade at the desired price levels. Order confirmation and trade execution. Once your orders are filled, review the trade confirmations to ensure accuracy. Your guts trade is now active, and you're in a position to potentially profit from significant price movements in NVIDIA's stock. Remember, timing is crucial when entering a guts trade. Aim to enter the trade when you anticipate heightened volatility, such as around earnings announcements or product launches. Exiting a guts trade is just as important as entering it, as it determines your overall profit or loss. Here are some strategies for exiting a guts trade predefined exit points. Before entering the trade, set clear exit points based on your profit targets and risk tolerance. This helps you make rational decisions and avoid emotional trading. Profit targets. Set realistic profit targets for both the call and put options. If one option reaches your profit target, consider selling it to lock in gains, even if the other option hasn't performed as well. After taking profit on, for example, the calls, you can wait for the stock to come down and then sell the put option. Trailing stop-loss orders. Use trailing stop-loss orders to protect your profits and minimize potential losses. A trailing stop-loss automatically adjusts your exit point as the price of the option moves in your favor, locking in profits while allowing for further upside potential. Time decay considerations. Remember that options contracts lose value over time due to time decay, also known as theta. The closer the expiration date, the faster the time decay. Factor in time decay when setting your exit points. Market monitoring and adjustments. Continuously monitor the market and NVIDIA's stock price movements. If your initial analysis proves inaccurate or market conditions change, be ready to adjust your exit strategy accordingly. Exiting a guts trade requires a balance between securing profits and managing risks. By following these strategies and staying adaptable to changing market conditions, you can improve your chances of successfully exiting the trade and achieving your investment goals. Thanks for watching, and till next time. And please like and subscribe.